Hey guys! I think each of you will agree with my statement that gambling is a very bad thing. But then I have a question for you. Why on earth are you still using trading bots that operate based on the Martingale strategy? The thing is, about 70% of trading bots currently used in the financial market employ, to some extent, a capital management tactic called Martingale. After all, this is the very same gambling strategy that wasn't invented by traders, but by casino gamblers. In casinos, the Martingale tactic refers to a game where you double your bet after you lose. As for trading, Martingale means increasing the size of your trading lot every time you take a loss. And essentially, it's the same thing. Agree, whether in trading or in a casino, Martingale means constantly increasing your lot size, constantly raising your bet after you incur a loss. In this video, I want to explain to you in a bit more detail how Martingale works and why it's very dangerous. So how does Martingale work in a casino? Look, let's say you bet on red or black. Let's say you put $10 on red, hoping that your bet will win and you'll get double the payout. You bet 10, you get 20. So when you bet $10 on red and black comes up, in other words, you lose, they take your $10. And in order to win back your losses, you bet $20 on red, hoping that your winnings will now be $40. So you'll recover the money you lost and even make a little extra. If your $20 bet doesn't win, then you bet $40. If you win, you get $80 or you lose $40. If the $40 bet doesn't win, you bet $80, then $160, then $320, then $640, and so on. So, as I mentioned earlier, the idea is that your future winnings will cover all your previous losses and you'll even make a little extra on top. But there are several major problems because of which everyone ends up losing. First of all, you might simply run out of money to double your bet the next time. As I said before, first you bet 10, then 20, then 40, then 80, then 160, 320, and so on and so forth. And then let's say your next bet has to be $5,000. And you think, oh my God, what is happening? And either you just stop playing or you bet even more again and lose it all. And now you don't have any money left to double your bet, that is, to bet more. There's also the problem that the law of probability, which supposedly guarantees us that the same color won't keep coming up, actually has some kind of arithmetic error, and from time to time you get a streak like that. A long series of outcomes where you keep getting red or you keep getting black. And you keep doubling and end up losing everything. And finally, many casinos either completely ban the use of the Martingale system, or for example, they tell you that the minimum bet on red or black must be, for instance, $50. In that case, you need even more money to start playing using the Martingale system. And the more money you start using, the more money you will end up losing. And the faster your capital will run out. I think everything is clear here. In other words, you understand how flawed this tactic is when you start playing with these laws of probability. Now, when it comes to trading, things get even trickier. First of all, because you can be under the illusion of a strategy tester. First, the developers could have tailored the test results so that the expert advisor wouldn't lose money in the tester. You run a test, everything works smoothly there, with no loss of capital. You put the trading bot on your live account, and after a while, it drains your entire deposit. Because the developer simply faked the test results. Second, once again, you don't have enough capital. Third, you hope that the market will always move in a diverse way and that it's impossible to lose your capital. But you have a trading strategy, you're not making random trades. For example, you trade on trend reversals. But there are uninterrupted trends in the market that can last for weeks. And during that week, you could lose not just one deposit, but several at once.
Guys, to show you in practice how often modern traders use dangerous money management, I've opened the signals page on the MQL5 portal, and I'll show you the signals, meaning the trading monitors of traders. Take a look. I'll filter the signals by the maximum growth parameter and open them one by one to show you that in these cases, traders are using averaging. Next signal. Traders are using averaging and martingale. On the gold currency pair, he's just using averaging. But on the Australian dollar versus Canadian dollar pair, he's using martingale because he's trading with different lot sizes, increasing them exponentially. This is also risky, although in terms of the growth parameter, everything looks very nice here. Let's move on. Third signal. Here we have martingale, because as you can see, on one currency pair, he's trading with different lot sizes. He starts with 20 and then goes to 30 to 50. Here I see there's one lot. So, in this way, he's averaging with the addition of martingale. This is very risky, but as you can see, it's very profitable. He made 1500% in 3 years. So, the fourth and final signal is, and it's a crucial one, averaging. The fifth signal is martingale. Sixth signal is martingale. So right now, we've meticulously opened and thoroughly examined the very top signals on the MQL5 market, specifically prioritizing them by the maximum growth parameter. And what exactly do we comprehensively have as a result? We find either pure averaging strategies or the well-known martingale system, or even a combination of averaging with martingale. All of these are clearly present to vividly show and demonstrate just how incredibly badly and catastrophically things can ultimately end in such trading scenarios. So this person has now made 1800%. You might say, but that's such a huge profit percentage. Well, maybe it's risky, but we'll just keep withdrawing money little by little. And let it be risky, but the profit percentage is high. Look, guys, why is it only 1800? This portal has existed for several decades. And our most profitable trading signal is the 1800, and it hasn't even been around for a full year yet, while this particular signal has already been active for 2 whole years now. And this signal is almost 3 years old. Where are those older signals that have been running for 4 or 5 years? Guys, there aren't any. They've all gone bust, every single one of them. If only. If there were a system in the world that could deliver good profits, a stable system using martingale, then by now it would have shown 20,000, 30,000, or even 50,000% returns here. But there are not any. They have all gone bust. And I have to ask, what is the point of these profits that you work so hard to earn? Trading for 2 or 3 years? Waiting, hoping, opening this signal every day, checking, watching how your expert advisor is trading, what deals it is making, only to lose it all in one moment? What's the point of that? Guys, don't chase after huge profit percentages. You need a modest profit percentage, but profit plus stability. Let it be not 1800% over this period, over a year, but 50 or 100% that you won't lose without the risk of losing it.
Which is better?
1800 with huge risk or 100 without risk? I think any reasonable person would say 100 without risk. That's what I urge you to do. To act and think exactly the way I do. Don't chase after big profits, chase after great stability. That's exactly what my course is focused on, so that you learn to trade automatically, to earn automatically, without risking your capital. It won't be 1800% a year. It will be 50 or 100% a year, but without the risk of loss. That's worth a lot, because I'll show you more. What happens? Look, I showed you, filtered it. From one side, we're looking at the most profitable ones, but there's also the other side. An endless number here with losses. These are the ones that haven't been deleted yet. People who just blew up their accounts and don't even know you can delete them. They left them there. Although usually signal providers delete their negative results that they want to avoid showing. Lack of any experience in trading. Look, the man is already trading. A full year and cannot understand that this is an unprofitable system. And this is a trading system with Martingale. Why are you doing this, boy? Remove this signal and don't waste your time on such trading. Because even... Okay, I won't say bad words. In general, you get the idea that these kinds of signals, regardless of the deposit size, see such a sad code, 64%, you think, well, kind of. 64, the guy is trading carefully. The maximum drawdown is 14%. But here is Martingale. Look at these spikes. These are the characteristic teeth of a Martingale system on the deposit growth chart. I'll show you. Here, 1, 2, 4, 8, that is to say 3 consecutive losing trades. And then the fourth subsequent trade proves to be quite profitable, and it effectively covers all the accumulated losses from the previous 3 unsuccessful trades. Let's take a look. Here's actually a good example. The person made 1, 3, 4, 6 losing trades, and then the 7th one was profitable. Already with a size of almost 1.5 lots. That's a very large, significant size, especially on such a volatile asset as gold. Everything could have ended very, very badly indeed, and the person might not have just made 6 losing trades and 1 profitable 7th, but say, perhaps 10 or even 12 significantly losing trades. I assure you with absolute certainty, if such a truly devastating series of events had happened, this particular trading account would no longer exist at all. It's just by sheer chance and good fortune that he's still able to actively trade and ultimately make a remarkable 63% profit. During this period, even though he is very close to losing his deposit and could lose it at any moment. So, what's the point of trading for a year just to lose everything in an instant? It's better to earn that 64% in a year using a regular risk-free trading system.
And most importantly, there's another trap you fall into. You see that on some trading account, the developer or some seller has been making steady profits with Martingale for several years in a row. Consistent profits. You look at a signal where you see that the expert advisor has been working in profit for 3 or 4 years already, and you think, what could possibly go wrong? This trading bot, even though it's risky and uses Martingale, seems quite stable. If I just follow all the developer's advice, who, just like me, uses this trading bot, then everything will be fine for me too. So guys, this is a big trap because the financial market is designed in such a way that it doesn't let us earn too much using such simple, yet at the same time risky trading strategies like the Martingale tactic or, for example, averaging, which I'll talk about in the next video. The thing is, we're trading against big, powerful corporations that will either create relentless trends so that we lose money if we're using a reversal strategy, or for example, they'll create a flat market so that those who use such strategies also end up losing. Trend trading, and Martingale in particular, is exactly the kind of dangerous booster that allows us to lose our hard-earned money much faster, because it simply cannot withstand such prolonged and challenging trials and is only truly aimed at overcoming short-term, fleeting obstacles. Simply put, my dear friends and fellow investors, remember this one crucial simple thing forever. If you genuinely intend to make automated trading one of your primary and reliable sources of income, or use it as a powerful tool for long-term investment and steadily growing your capital, then Martingale-based strategies should absolutely never ever be a significant part of your carefully constructed portfolio. If you hear the word Martingale, run as fast as you can. See you next time.